Hi. So we are going to look at chapter 5 now, and this is called Trade and Cash Discounts. So basically, what we're looking at here is we're talking about profitability of companies and how they are able to generate profit. And we look at that whether they're the manufacturer, the retailer, the wholesaler, and services as well. So we're looking at um, producing revenue or the income. In a retail business, it would be sales or cash received. Um, and so all of these go into what we want to know is what is our profit? What are we going to make? Um, so that is the income minus the cost of everything that it took to make those items. So we want it to be a positive number, right? It should be. Because if not, then you're not making any money. You're losing money, and it's not a good idea to stay in business. Um, but we look at two separate types of costs. We look at cost of goods sold, or the net cost, which is the cost of the merchandise that the retailer paid to the supplier. So the cost of that actual goods. We also have to think about the operating expenses or the overhead. So what other expenses are taken into consideration? Salaries. We got to keep the lights on, right? So we got utilities, advertising, some things that would be considered in the cost. We also want to look at break even. So we want to make sure we at least break even, but we want to make a profit. But break even is when there's the total cost based on the income. So then we look at the two types of profit. We have gross profit and we have net profit. So gross profit is before the operating expenses are taken into account. So that's really not what we really want to see. We really want to see the net profit, because that's after we've taken into consideration the overhead. So we can look at this on this little chart, and we would start at 0, and we can look at the cost of goods sold and operating expenses, a break-even point, our net profit, and our net sales. And so when we put those all on that number line, it can help us to answer those questions that we're going to have related to profit. The number line begins at 0 and ends at net sales. So we talk about the net sales being the income after any returns. So we got to think about returns. We did that from last chapter. So we want to, we're going to divide that into the sections. So we want to organize it. So basically, think about these when you look at the number line. A position in the following section can be added to produce the next position. So when we're moving from to the right, we're going from left to right here. A position in the previous position can be subtracted to produce the previous position. So we're subtracting, we're going to the left. And 2 consecutive positions can be subtracted to produce the one in the middle, so that we have the distance between the 2 points. So based on that, we are going to set up an example, and we're going to set up a problem. So here we go. Ray's Music Exchange has net sales of $495,000 last year, with cost of goods sold of $255,000 and operating expenses of $223,000. So we're going to complete the number line, so it makes it easier for us to answer these. So remember, we have this number line up here. We have the cost of the goods sold, and we have that as $255,000. So we're putting those in those two blocks. We are looking at the operating expenses, which was $223,000, and we're also given that the net sales was $495,000 last year. So we are looking for this amount, right? So to produce the number at the break-even position, we're going to add the cost of goods sold and the operating expense sections. So remember, we talked about that. We said that we were going to go from left to right. So we're looking at the $255,000 plus the $223,000, which gave us the $478,000. So we also want to know the length of the section for net profit. So we're subtracting the break-even point, which was that 495. Which was the 478,000, and we just got from the net sales of 49.5, and we get 17,000, which would be then his profit for the last year. So when we have that diagram, we can put it into an income statement. We are going to be looking at financial statements in a few chapters, and you'll be setting up your own. And so this is just the start of that. And you can see that all of those items can go into that income statement to give you the document that you need for the income statement. It would have more detail, but this is just a simplified little example. So we can also use the number line when we look at the profit from the sale of a single item, and then we would look at net cost in this situation. So we would say that Valley View Toys sells a particular model bicycle for $125. Okay, so that's at this end right here, this net sales. It purchased these bicycles for $65 each from the supplier. So you have the $65 and estimates that that the overhead expenses are going to be $40, right? So we originally paid $65 each. The overhead is going to be $40. So if we add those two together, we have $105, which is our break-even point, because if we decided to sell the bicycles for $105 a piece, then we would make back the $65 that we spent from the supplier, plus the $40 in the overhead, to give us the $105. But that's not what we want. We really want a profit. So we have decided that we're going to sell them for $125, right? So we want to see what is the difference between what we are selling them for and our break-even point. And that will give us 20. So that means that we're going to make $20. $20 net profit per bicycle. We can do this if we don't have the net sale and we want to know what that is. For the sale of a wrench, a store covers $6 in operating expenses. So that's that 6 in the middle. That's the operating expenses. We are looking at a $2 net profit and the break-even point of 14. So that's how we set those up on the number line. Remember, they always start with 0. And so we can get the selling price by adding that 14, which was the break even, plus the $2 that we said that we were going to add. And that gives us 16. So then we want to subtract back and find out what the our price was, how much we paid for it. So we get $8 when we subtract the 14 minus the 6, because remember we can subtract back each one. So a loss would occur when, of course, the costs are exceeding your income. But we can look at the number line again to help us with that. So we are have this example here, and I've got the net cost, the selling price, operating expenses, the loss, and the break-even point. So see, it's shifted a little bit because of the fact that we're looking at the loss for these items. So for an example, so we set it up, a kitchen store purchases a mixer for $45 and sells it for $55. Operating expenses are 30% of the cost. So we want to find the break-even point and the loss. So our operating expenses is going to get us to that break-even point. So if we spent $45 on the mixer and 30% of that, or on top of that, is our overhead, then we know that our overhead is $13.50. So when we add $45 plus the $13.50, we get $58.50. But if you look at the problem says that they're selling them for $55. So technically, we're losing money because the difference between the $58.50 and the $55 is $3.50, which you can see on that chart would be the operating loss is there. So technically those are negative. We don't usually, when we're talking about accounting and finances and stuff, we will use the parentheses around the number to make it be because it's more obvious that it's negative. I've also seen that they put the negative in red because you're in the red, it's red, so it's negative. So then we have something called an absolute loss, and it is the amount by where the net sales falls below the net cost or the cost of goods sold. And so we would have, or the company would have, an absolute loss and an operating loss. So the operating loss is still that amount by where the total costs exceed the selling price, but the absolute loss is a portion of that operating loss. We don't add them together; they're a portion. So if we look at this and it says to fix it yourself shop, purchase a certain model of power screwdriver for $35 and operating expenses of 23% of cost. Customers were not impressed with the screwdriver, so the store had to put it on sale for $25. So what are the operating absolute loss for that sale? So the operating expenses we find are 23% of that $35. So it was $805. So if we look at, we paid $35 plus the $805, then we've got the $43.05, right? And you can see that on that number line right there is the $43.05. Okay. The absolute loss is the amount by which the sales price falls below the net cost. So in this case, the absolute loss is 10. So the operating loss is the amount the sales price falls below the break-even point. So if we look at that, we're adding those two together and getting $18.05. So the absolute loss is 10. And then we find out that the operating loss, which is the total amount, is 1805 because 10, remember, is part of the total 805 on that case. So there we have losses. Now we're going to look at trade discounts. So manufacturers will give businesses discounts for items that they buy. Maybe if they buy in huge bulk, or they just know that this is not, there's a certain list price that the consumer could expect to pay, and so they look at a price lower than that, so that they'll be able to companies will be able to make a profit. So businesses then need a discount, because if the list price is a certain amount, this is how much that the product should sell for. And so if a company says, okay, if it's supposed to sell for 25, I don't want to pay 25 for that product. I want to pay something less so that I can make a profit. And so that's where you get the trade discount on that. So, and it varies. In this example, a vacuum cleaner is nationally advertised for $279, so that's your list price. One of the suppliers of Terry's vacuum sales offers this machine at a 40% trade discount. So what will the vacuum cleaner actually cost Terry? So Terry is receiving a 40% discount, so she's paying 60% of the list price, which would be $279 times the 0.60, which gives us $167.40. So she's paying $167.40 for each vacuum cleaner, hopefully to sell it for $279. And so she's got that room in there for her overhead costs and stuff too. So we look at that if the list price is not included, then the complement can't be used like we did in this one. We need to look at our percent change diagram. Remember that? We saw this before in an earlier chapter. So value market paid $93.39 for a particular model of ceiling fan. After their 45% trade discount, what was the suggested list price? So if we look at this and we say, we subtract the percents on this left-hand side, we get 100 because the change is the net. So we're subtracting because it's a discount, right? We would get the 55%. So then once we get that, we can just set that up in our proportion like we did before, and we can say 45 over 55 x over 93.39, which is the same as where it says here the 93.39 times 100 divided by 55, which would give us the 169.80. So sometimes a company will give a series of discounts, the supplier. So it could be a series discount or a chain discount. So for example, this one here, if the supplier offers a 25.15, then that means a 25% trade discount will be taken from the list price, and then 15% trade discount will be taken from the discounted price. Okay, so what does that mean? Okay, here we go. So a vacuum cleaner is nationally advertised for $279. Another supplier of Terry's vacuum sales offers a 25.15 series discount. What would the vacuum cleaner cost from this supplier? So if we look at 25.15, again, we're using the complement here. So the complement of 25 is 75. because 100 minus 25 is 75. So we're going to say 279 times the 0.75, which gives us the 209.25. Then we're going to apply the 15% discount to the first discounted price. So we've got to find the first discounted price first, and then we go to the second one. Again, we're using the complement, and the complement of 15 is 85. And so when we do that calculation, we get that the vacuum cleaner, Terry's cost would be $177.86. And that's pretty much the easiest way, or one of the ways to do it. You can put it in together and say 279 times 0.75 times 0.85, and you're going to get the same answer. But again, when we look at this, we're not, combining it. So it's not like it's remember before when we looked at them and, we would want to say it was a 25-15, so it's a 75 plus an 85% discount, and we can't do that. We have to do it separately. We could also multiply those two percentage complements together and get an amount, and then that would help us to solve the problem as well. And it would also help us give us the net cost equivalent of the discount. So we would end up getting 36.25 because we are getting that discount on there. We can even do it for 3. So we got 3 series. We've got 3 discounts. We've got a 30, 25. So again, the complement of 30 is 70, the complement of 20 is 80, and the complement of 5 is 95. So we're multiplying all those together and getting 0.532 to get the single equivalent discount. Remember, we have to subtract that from 1. So in that case, we get 0.468, which is a 46.8% trade discount. Next example. Find the list price of an item whose cost was $600 after a 2510 series discount. Setting it up the same way, we want to use the complements, and we get the percentage. We can use our little table again because we need to set it up as a proportion, and we would figure that out based on the chart, and we would get the list price to be $889.89. Another example, Swiss Time is offering a wall clock to their retailers at $59 less 55%. Beaver State Clocks, a competitor, has a similar model price at $62 less 40%. What additional percent discount is needed for Beaver State to match Swiss Time's price? So we look at first 59 times the 0.45, which remember is the complement to 55%. So Swiss Time's clock costs $26.55. Beaver State's clock costs $37.20. So we want to find out what discount would decrease $37.20 to $26.55. So again, we look at our little chart, we put everything in our chart, and we look for the percent change. So Beaver State needs to offer approximately an additional 29%. So it really could be 28, but we probably would end up looking at 30. So it would look like probably a 40-30 discount. And a company can do that for a short time if they know that there's something going on in the market or something like that. Then also we could get volume discounts as well. So if we bought more than, we might get a different discount or a bigger discount if we bought more than a certain amount. So Gallivant Industries offers retailers a wrist-worn fitness tracker for $129 each, plus a trade discount of 35%. So if a retailer orders at least 12, they would get an additional 5% volume discount. So we want to know how much 18 fitness trackers cost. Okay, so we know that 18 times 129 would give us the amount if they weren't giving us the discount, right? But they're giving us a trade discount of 0.65, well, of 35, and the complement is 0.65, and then an additional 5% volume discount, which would be that 0.95. And so that would be giving us the answer of how much 18 fitness trackers would cost. When we look at cash discounts kind of, it's like if you pay early or pay on time, then you might get a better discount than if you paid regularly. And so we look at, for example, a 210. So we're looking at it a little bit differently. This example means that a 2% discount is available if the invoice is paid by the 10th day after the invoice date. So we still are computing it the same way as the trade discount, and we can still use complements. But what we're looking at is that if the invoice is not paid within the cash discount period, then you can't take the cash discount. Okay, so you would have to pay the amount that was regularly, the net due amount. So we would also look at net 20 or N20. Those examples both state that the net due date is 20 days after the invoice date. If it's not specified in the invoice, then the net due date is usually 30 days after the invoice date. And sometimes you might see that the shipping costs and stuff too, and so you might have to add that on as well, depending on where it's being shipped to. So we have an invoice, and we want to figure out the last date of the cash discount, the net due date, and the amounts due from retailer from each date. So we are looking at 5 notebook computers for $9.95 each. So if we multiply $9.95 times 5, we're going to get the gross, which is $49.75. If we want to get the gross of the 2 dozen computer speakers, they're $59 each. Remember, 2 dozen is 24, so we're not multiplying it by 2 or 12. We're multiplying by 24, or 2 times 24 times 59, which would give you the gross. And then you've got gross. That is a measure of quantity, and gross is equal to 144 items. So we know that we've got 3 gross, which is 144 times 3, and those are 30 cents each. And so our gross on those, the gross on the gross of the DVD or disc is $129.60. And so then we want to go to the last column because they've given us the trade discount and we want to know the net. So the net column is found by applying the trade discount to the gross amount. So again, we're using the complements. We have the gross amount of the notebook computers, which was $49.75, times the complement of 55, which is 45. So our net would be $2238.75. You do the same way for the different trade discounts. You got a 40-10, using the complements, you find the answer to that. You've got the 35-15-5, you do that too. You also need to make sure you add in the total, the shipping, so that we have our completed invoice, and so that's what it would look like. So in this example, we see that the terms, so we got all that. Now we got the terms. It says 3, 5 in 20. What does that mean? So the terms mean that there's a 3% cash discount and expires 5 days after May 17th. So it expires 5 days after the date of the invoice. So the last date of the cash discount is available is May 22nd. So as long as they pay by May 22nd, they can get a 3% discount on top of what they're already getting. Okay. But we only want to look at the goods and not the shipping costs on here. So we want to subtract the shipping costs first, because we want to we're not talking about a discount on the shipping. So we subtract that, and then we multiply again by the complement, and the complement of 3% is 97. So we get $29.79, which would what we would pay if we paid between May 17th and May 22nd. But don't forget to add the shipping back on, so we would end up paying $3,029.27 as opposed to the $31.21 that we would pay if we were later than the May 22nd. Okay, next example. So Gabriella receives an invoice dated August 15th for $38.50.45, and the total includes a $174.50 shipping charge. Remember, we have to subtract that out if we are going to pay between those, the discount dates. So the terms of the invoice are 2/10, net 25, and a 5% penalty for late payments. So we want to know how much she would pay if she paid on those following dates. So we know that the first one is the 2, so she would have to pay by she'd have to pay by 2%, 10 days. So she has until the 25th. So if she pays by that time, then she would get that discount. So if she paid on the 23rd, she get the 2% discount. If she pays on the 25th, she does too. So we look at that 2% discount, and again, we're looking at the complement, which is 98.98. We are remembering to subtract the shipping charge first and then adding it back in. So if she paid by August 23rd, she would pay $37.76.93. September 3rd is 19 days. And then you would just figure that out based on the 19 days. And on the and then on the this one on the 13th. So we do have a table of days. So there's a table for this too, and there's one for leap year too, and it will help us solve these problems. And I have it included. It's the same. Actually, I think it is on the same one as the withholding. So it's probably in the back of the module for the chapter 4, but it's there. So we look at, it gives the day of the year for each date, and that will help us to solve some of our cash discount examples. So an invoice for $755, which is dated October 21st, 4th, has the terms of 250, so that would be 2% for 50 days after, net 90. Find the last day of the cash discount, the net due date, and the amounts due from the retailer for each date. So we look at it, we see that the 2% cash discount expires 50 days after October 24th. So the table of days identifies October 24th as, so if we go down the chart, we go to October 24th, 297. Okay, it's a 297 day. Adding 50 days to that, because we're saying the 2% to the 50 days. 50 days to that would give us 347. So then we would look at 347, December 13th would be that day. So the net due date is 90 days after October 24th. So we would look at the two amounts based on when we would pay it. And so the 2% would be after 50 or within 50. And then after that would be the net amount would be responsible for that. Now, remember, we have leap years. Yeah. So if it asks you about that it's a leap year one, then there's another table for that because the number of days is different. So again, if we look at this example, the invoice is $386 and you've got these terms. Find the last date of each cash discount, the net due date, and the amounts due on each date. So we would, we know that looking at the 3.5, that it's 3% and it's for 5 days. So the discount expires 5 days after February 21st. So that's February 26th. We don't need the calculation for that one, the table of days, because we just have that, we know within 5 days. If we pay that within 5 days, we will get that 3% discount. And what is that 3% discount? It's 386 times 0.97. Remember the complement of 3? So that gives us the amount of $374.42. So as long as we pay on or before February 26th, we would only pay $374.42. The next discount, because they're giving us another discount, expires 15 days after February 21st, and it's a 1%. So if we looked at 15 days after February 21st, and then we can look at the chart on this one, and we can say February 21st is day 52. Adding 15 to that gives us day 67. Oh, but wait, this is a leap year, which occurs in March. So we have to look at the other table. So we have to make sure that we do that as well. And then we get, if we look at adding 15, gives us a 67, which gives us to March 7th. And then, so on or before March 7th, you would pay $382.14, because remember it was a 1% discount, which would, the complement would be 0.99. The net due date is not specified, so we count 30 days from February 21st or 15 days from March 7th, the last cash discount date. So the net amount of $386 would be due on March 22nd. Sometimes you'll see EOM or end of month. So that means that the cash discount period, the last day of the cash discount period is a specified number of days after the end of month. For example, if you have 210 EOM, then you would have the 2% cash discount. is available if the invoice is paid by the 10th day after the end of the month of the invoice date. Okay, so if the invoice date is March 15th, then you have 10 days after the end of the month. So 10 days after the end of March, which will be, I'm trying to think how many days March has. 30 days, have September, April, June, and November. So it's got 31. But yeah, it's got 31. So then you add the 10 to that, and then that gives you the date for that cash discount. Also, Proximo is used sometimes, but typically we're going to use EOM dating. If the invoice is dated on the 26th of the month or later, usual standard practice, but I would check with the company, of course, is to allow additional month for the cash discount period. And so instead of it being 10 days into the next month, it would be 10 days into the following. So let's look at some examples of that. An invoice is dated April 14th with terms of 210 EOM. Find the last day of the cash discount period and the net due date. So the cash discount would end 10 days after the end of the month of April. So it would end May 10th. And the net due date would be 20 days later on May 30th. So if we have one that says it's dated June 29th and has terms of 115 Proximo, find the last day of the cash discount period and the net due date. Since the invoice is dated after the 25th, we skip a month. So the cash discount period ends 15 days into the next month after July, which of course is August. So it would end on August 15th. And the net due date is 20 days after the discount ends on August 15th, which would be September 4th. Sometimes also suppliers can add little extra things. The use of extra or X dating. So the example is 220 and then it says 50X, which means there's a 2% discount. Cash discount is available until 70 days. So the original 20 days plus an additional 50 days after the invoice date. So this is commonly abbreviated, and you can see that it says EX instead of the X, so you could see either one. So we look at sometimes if there's like a seasonal merchandise, we will see that. So the net due date default rule for extra dating is the same as for end of month dating. So you're adding 20 days to the last day of the cash discount. So an invoice is dated November 20th with terms of 2/30 ADX. Find the last day for the cash discount and the net due date. So the cash discount period ends 110 days after November 20th because we have the 30 plus the 80, which would give us 110. So the table of days indicates that November 20th, so we're going to look at November 20th. I don't think this is a leap year, so we get to look at a regular one. So if we look at November 20th, 324, if we add 110 days to that, we get 434. So that's going to take us to the next year. So we need to subtract 365 from the 434, and we get 69. So then we look at day 69, which would be March 10th. So the last day discount date is March 10th, and the net due date is March 30th. But if it's a leap year, then we would look at March 9th and March 29th. Those are examples of those. Another thing that a manufacturer might do is to require maintenance when the retailer receives the goods. So instead of the invoice date, it's the date of the receipt of goods, or ROG. So the net due date for ROG dating is also 20 days after the cash discount expires. So if we have an invoice that was dated March 5th with the terms of 110 ROG, the retailer received the merchandise on April 28th. And so then we would want to know when the cash discount expires based on that April 28th. So we would, the cash discount period ends 10 days after April 28th. So we add 10 days to 118, which is the amount on the table for April 28th, which is May 8th, because we've added 10, so that's 128. And so we look on it, and that's May 8th. And if the invoice is paid after May 8th, no cash discount applies, and the invoice amount is due May 28th. So that's your chapter on these trade and cash discounts. It's a little bit shorter than some of the other ones. So I hope that this one hopefully will be a little bit easier for you. But again, if you've got some issues or some problems, please let me know and I will help you with those. All right, don't forget, look at your chart and make sure you're using the right one. All right, see you later. Thanks.